Hi traders, in this video I'm going to talk to you about the commitment of trader reports and how best to use them for trading the markets. The commitment of trader reports really great piece of sentiment analysis that can help us really identify what's going on from not just a technical basis but from a fundamental basis as well. Now, just to get into it, what is a commitment of trader report? If you don't know what a commitment of trader report is, I've just made some notes here. So, and this is from the CFTC, which is the Commodities Futures Trading Commission website. So this gives you the better breakdown of it. And specifically, the CoT reports provide a breakdown of each Tuesday's open interest for futures and options on futures markets in which 20 or more traders hold positions equal to or above the reporting levels established by the CFTC. And there are four main reports. You've got a legacy reports. Now, legacy reports are broken down by exchange, and these reports have a futures only report and a combined futures and option report. And legacy reports break down the reportable open interest positions in the non-commercials and the commercials trader, which is something that I focus on particularly when looking at the markets. You've got supplemental, and that includes 13 agricultural commodity contracts for combined futures and options positions. Again, this will break down the open interest with the classifications of non-commercial, commercial, and index traders. You've got the disaggregated, and these reports are broken down by agriculture, petroleum products, natural gas, and electricity, metals, and other sort of physical contracts. And these reports have a futures only report and a combined futures and options report as well. And this the same classifications again pretty much, although the disaggregated can have sort of producer, merchant, user, swap dealers, managed money, and other reportables. Traders in financial futures. So the traders in financial futures report includes financial contracts such as currencies, treasuries, securities, euro, dollars, stocks, VIX, and the Bloomberg Commodity Index. So going on to the history of the commitment of trader report. So the commitment of trader reports can be traced all the way back to 1924. And beginning of June 30th, 1962, CoT data was published each month. And it only really started to become free in the beginning of 1995. So it was quite interesting. It used to be a month-on-month report, and then it ended up going to 2 weeks and then going to weekly in the year 2000. But the report is now free, and it's available on the cftc.gov website. So if you do want to have access to that, you only need to go to that website and you'll be able to get all the information for free. Now, this is a sort of example of a short form commitment of trader report that you can get. Okay, and this is directly from the cftc.gov website. So it's the sample that they give you under the tab how to read the commitment of trader reports. Now, you're probably looking at this going, what the hell does this mean? So I'll just kind of break it down to you. So you've got the non-commercials. Okay, so like I said, non-commercials are more like your hedge funds, traders, things like that, and they typically are trend following. Okay, then you've got the commercials. They're in it for business purposes, so they tend to hedge. And then you've got the non-reportable positions. Now, we don't usually take notice of the non-reportable in the markets because they don't really have too much influence on what's going on. But you can see that under the sort of tabs there, you've got long and short, long and short. So basically what we're trying to understand is where are these different types of reports, and where are these different types of individuals? Are they more heavy to the long side or the short side, for instance? And another key thing, we need to look at open interest. Obviously, we want to trade a market that has a high open interest, because then obviously that means that the commitment of traders report may be a little bit more accurate. Okay, so if something's losing interest, then the volatility essentially might be a little bit lower. So going on to a commitment of trader report that you can actually read, I feel like that is quite a difficult thing to be able to read, and if you are going to be looking at these on a consistent basis, then it's going to be hard to understand the changes. Now you can see the changes are input below, so you can see the changes, and they give you a date. So obviously this is all the way back in 2006 with this figure here, but they'll give you the changes over a period of time, so you can see the trend within it. Luckily for us now, because it was made free, a lot of companies have created their own version, and this is a free version. Okay, this is a free version, and it's from barchart.com. Okay, now it's not the most sort of direct tool ever, you know, it's not the most sort of in detail tool ever, but it does the basics, and it does the basics pretty well. And there's sort of a couple of different ways that you can read the commitment of trade reports, especially for trading conditions. But my favorite way to trade these, okay, is by looking at the extremes. Okay, so trade extremes. And the reason why I like the extremes in the market is because it gives us really clear defined areas to work with. Okay, so one of those opportunities could be, so here we've got a little line chart down here, and I'll just tell you that the red line is the commercials. Okay, so if I just pop a little tab here and just say the red line are the comms. Okay, so remember, they're in the market for business purposes, they are hedging. Okay, so essentially what I mean by that is I've got a pound futures chart in here, and let's say there is a business that's doing international trade. Okay, they might want to hedge their position. So if they see pound kind of rising aggressively, okay, they're going to start to sell. Okay, because they are hedging that risk there, they're going to start to sell that. As soon as that starts to turn, they consider the pound, you know, fairly cheap, and they'll start buying on the way down. Okay, so that's the way I like to think of it in business. If the market or the price of a commodity that you have, a product that you have, is going higher, you're trying to sell more of it. Okay, because you get more profit back. As price declines, you're trying to buy more of the material. Okay, a really good example of that is more gold based. Price of gold falls, you want to accumulate more of it, don't you? Because then if price rises, you can sell it for a profit in the future, essentially. Now the opposite to that is the green line. Okay, so the green line, okay, they are the non-coms. Okay, so they are your trend followers. Okay, so they go with the trend. And the trend followers are essentially your hedge funds, traders, essentially. They're looking to trade with the trend on a week-by-week basis, and that's what the green line is. So when I'm trying to trade the extremes, what am I really looking for? Well, I'm looking exactly for that. I'm looking for extremes within the contracts. Okay, so if I just delete some of that information or all of that information off, and we just start with a line. What I mean by extremes is I like to look at where the peaks are, okay, and then I like to look at if price or the contracts come back within those areas. Really good example of this on cable, so, or pound futures, sorry. And you can see here, you know, approaching sort of middle of between sort of June and September of 2023, the short contracts on the commercial side were pretty much at a level that hasn't been seen for a very long time. Okay, so if I look left across this here, you can't really see another red line that low. The only time we can kind of see it relative is back here in June 2021. Okay, so what does that tell us? They're at an extreme. Okay, they are selling more than they ever have for a very long period of time. So that is an extreme there, and we can see what happens to price following that. Price declines. Okay, now another situation formed. So if I just drag that out to the right here, we can see that the commercials were selling heavy again at an extreme that had been seen recently, and that was after price had rallied more towards the 1.3 handle. And we can see what's happened after that. Prices continue to fall to the downside there, and you can see as price falls, the contracts are going higher. Okay, because they are in it for business. They are buying it because it's getting cheaper. Okay, And you can do the flip side, and you can look at it in the same way as the non-commercials as well. We can see the non-commercials at the time, if I look left, they were at all-time highs, or not all-time highs, but at highs that haven't been seen for a very, very long time on the commitment of trader reports. And it's almost like they're trend following this, so they are trying to buy it aggressively at a top, essentially, in the market. So you want to look for two different things. You want to look for the commercials to be selling at or buying at a rate that hasn't been seen for a long time, or at least at a rate that has been seen before. So like the example that we saw recently. Flip that over for the non-coms. You want to be seeing them going with the trend, but you want to see them going sort of overbought, essentially, or oversold against the previous data. Okay, so that's the way I like to look at the commitment of trader reports. Now, in terms of trading strategies around that, you can just apply simple trading strategies then. So when you see this kind of price action here, and you see sort of a bearish weekly close, because this is a week by week data, if you see a bearish weekly close, let's say in this condition here, where you've got lots of aggressive selling coming into the commitment of trader reports, you can look left, there's like a level of resistance around about the 1.3 handle, and then you just look for your trending techniques. So on a 4-hour time frame here, or daily time frame, you'll see the market making lower lows and lower highs, and you can just look at when the price pulls back into those lower highs to take positions. Obviously, then when you see this sort of commitment of trader reports kind of going back above the 0 line, that's when you need to maybe think about coming away from these type of moves. And again, if we look left, price was coming right down into the 1.2 level. Okay, so that if we look left on the commitment of trader reports, they started buying it, okay, aggressively into a previous extreme high on the commitment of trader reports, while what happened, buying then came into the markets. So that's what I like to do. I like to look at these sort of extremes, okay, the highs and the lows of the contracts, and then I like to see that if that matches up with a level of support and resistance, can we then see a move? And because these are weekly charts as well, it gives you an idea of what's going to happen potentially next. So I'm going to leave it there. Thank you for watching the video update. I hope you really found this interesting. If you did, please leave me a thumbs up and hit the comment section. Do you like the commitment of trader reports? Do you want to see me use the commitment of trader reports more in the future? And I'll catch you in the next video.